Okay, so today we're doing a deep dive into something kind of, well, unsettling.
Yeah, this one's a little bit intense.
It is. We got some info from a listener about money lending practices.
And not just the, typical stuff everyone thinks about.
Right. Not just the interest rates and all that, but like tactics that some lenders use to get, well, more than they bargained for.
Exactly, like aiming to get assets, sometimes even through the collateral, stuff like that.
Yeah. And that's what's freaking me out a little bit, to be honest. When I saw that, I was like, wait, hold on a sec. I mean, I know collateral is a thing, but I never really thought about it like that.
Yeah, it can be kind of a dark side to the whole lending world.
Totally. So can you like break it down for us? How does a lender actually use collateral to, well, basically walk away with someone's house or car? Seems kind of wild.
Sure. So first things first, let's talk about collateral itself. When you take out a loan, a lot of times you got to offer something of value to the lender as like a guarantee.
Right, like a safety net for them.
Exactly. And that's the collateral. Could be your house, your car, jewelry, even like financial assets, basically anything that has, real value.
So if you don't pay back the loan.
Boom. They can seize the collateral. And sometimes that's where things get, well, tricky.
Tricky how?
Well, the value of that collateral, it's not always cut and dry. Some lenders might, let's just say they might undervalue your asset.
Wait, undervalue. What does that even mean?
Okay, imagine this. You need a loan, say 50,000 bucks, and you put your house up as collateral. Sounds straightforward, right?
Right.
But here's the thing. They might assess your house, say it's worth, oh, I don't know, like 75,000. But in reality, it's actually worth double that, like 150,000.
Whoa, hold on. So they're saying your house is worth way less than it actually is.
Bingo. And you see, that difference in value, that's where they get you. Because if you default, they're not just getting their 50 grand back, they're snagging a house that's worth way more.
That's kind of messed up. Why would they even do that?
Leverage, my friend. Leverage. It's all about maximizing their gain. And let's be real, sometimes it's at the borrower's expense.
So basically, they're kind of hoping you mess up so they can cash in.
Well, I wouldn't say hoping, but, it definitely works in their favor if you can't make the payments. And it gets worse. Some lenders, they make it even harder to stay on track.
How do they do that?
They get creative with the repayment terms. They might make them super unclear or even change them up all the time.
So, like, you never really know when your payment is due or how much it is? That's nuts.
Exactly. And boom, you miss a payment. It happens, life gets in the way. But then you're on that slippery slope towards defaulting on the loan, and guess who's waiting at the bottom?
The lender with their hand out, ready to take your house.
All right.
It's almost like they're setting people up to fail.
Yeah, it can definitely feel that way. That's why, you got to be super careful. Read every single word of that loan agreement. And I mean every single word.
Yeah, don't just skim it. Really understand what you're getting into.
Right. If something seems off, or if they're rushing you to sign without explaining things clearly, that's a huge red flag. Don't be afraid to walk away.
Okay, so that's red flag number one.
Yeah.
Shady repayment terms. What else should we be watching out for?
Well, that whole undervaluing thing we talked about, that's a biggie. If a lender seems way too eager to lowball the value of your collateral, be suspicious.
It's like if you're selling something online and someone offers you like $10 for something that's worth 100, you know something's up.
Exactly. Do your research. Get independent appraisals, especially for big stuff like houses or cars. Know what your assets are actually worth.
So it's all about being informed, really. Do your homework before you sign anything. Don't let anyone pressure you.
You got it. Knowledge is power. You have the right to walk away from any loan offer that just doesn't feel right.
That's such a good point. You don't have to say yes. You have options. You have the power to choose what's best for you. And even if you're feeling, pressured or lost, remember, there are resources out there to help.
Oh, yeah, for sure. There are consumer protection agencies, legal aid, all sorts of places that can give you guidance and support.
So don't hesitate to reach out if you need help.
Yeah.
This has been, well, eye-opening. Makes you think, what can we do as a society to, fix this? This can't be how lending works.
It's a big question, right? But I think it starts with awareness. We need to talk about this more, educate people about their rights as borrowers, and honestly, we need stronger regulations, more oversight in the lending industry.
Yeah, we need to prevent these predatory tactics from happening in the first place.
100%. Everyone deserves access to fair and transparent financial services.
Couldn't agree more. Well, this has been a lot to process. Thanks so much for breaking it all down for us.
Happy to help.
And to everyone listening, remember, knowledge is power. Stay informed, stay vigilant, and never stop asking questions. Until next time, keep exploring. All right, so we've got this source here, and it's comparing banks and real estate in Africa to, like, identical twins. I mean, come on.
It's a pretty bold statement, right?
Yeah, identical twins. Makes you wonder what they're really getting at. And you know me, I'm always up for a deep dive, especially when we're talking about big money, big buildings, and, well, leverage. Lots and lots of leverage.
Leverage is definitely the key word here. And in Africa, it's almost like this whole other level of the game.
The source keeps going on about this rate of profit turnover thing. And it seems like it's not just about making a profit, but like how fast you make it.
You got it. The faster you can turn that profit around, the quicker you can reinvest it. Buy more property, expand your portfolio.
So it's like a snowball effect.
Precisely.
And banks obviously love that.
They love to see that money flowing.
Makes them feel a little warm and fuzzy, huh?
Well, it definitely reduces their risk.
Yeah.
When they see a borrower with a proven track record of generating quick returns, they're much more likely to lend.
Okay, hold on a sec. You're telling me that when I put my hard-earned cash in the bank, they're just going to turn around and lend it out to some real estate tycoon. That's a little freaky, don't you think?
It is a bit mind-boggling when you think about it, isn't it?
And this source, they're even saying that African banks borrow people with cash flow and don't even use their own money. Are they serious?
I mean, that's a pretty colorful way of putting it, but it gets at this whole idea of fractional reserve banking.
Fractional reserve.
Yeah.
Okay, break that down for me. I'm not exactly a finance whiz.
So banks, they only keep a small percentage of your deposits on hand, in reserve.
Okay.
And the rest of it, they lend it out.
To build those shiny skyscrapers, I bet.
Well, yeah, among other things.
Yeah.
But the point is, every time they make a loan, it creates new money in the system.
Now that is trippy.
Yeah.
So it's like they are borrowing the financial stability of their borrowers, in a way.
You could definitely see it that way.
The source also mentions this thing about owning like 5 arcades and using the income from 3 of them to buy even more property. Is that a real thing?
It's definitely a strategy that some real estate developers use.
It sounds kind of like a game.
Well, it's a game, all right?
And in Africa, it's a whole different ballgame, right?
Absolutely. There's this rapid urbanization happening and infrastructure development is booming. Plus, you've got all these unique factors like land tenure systems that really shape the market.
It sounds complicated.
It can be. But for those who know how to play the game, there are huge opportunities.
Speaking of opportunities, what about those who don't have a stack of arcades to leverage? The source talks about microfinance loans, and those often come with crazy high interest rates. Seems like a totally different world.
Yeah, there's definitely a huge gap there. Microfinance is important, don't get me wrong, but
Yeah.
it's not a perfect solution.
It's like they're playing a different game entirely,
Exactly.
with different rules.
And higher stakes, unfortunately. The interest rates can be crippling for small businesses and entrepreneurs trying to get a foothold in the market.
So on one hand, you've got these big players making big moves, and on the other, you've got people struggling to make ends meet. That doesn't feel very fair, does it?
It raises a lot of questions about economic equality.
So how do we bridge that gap? I mean, is there even a way to make things more balanced?
That's the challenge, isn't it? There are a lot of ideas out there, from policy changes to financial literacy programs, but it's going to take a lot of effort to create a system that's more inclusive and gives everyone a fair shot.
Yeah, that makes sense. So what we're really talking about is not just real estate or banking. It's about people.
Yeah.
And their opportunities.
Yeah.
And how we create a system that works for everyone.
Exactly.
That's a pretty big takeaway.
It is. And here's something to think about. The source, it focuses on the strategies of the wealthy. But what about everyone else? How can we create a system where everyone has the chance to leverage their potential and build a better future? That's the real question.
Yeah, that's a good question. That's something for all of us to ponder, I think. Thanks for joining me on this deep dive.
My pleasure.
It was a fascinating one.
It definitely was.